Welcome to the Cashflow Project podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cashflow Project podcast. I'm your host, Steve Fieros with Tri-City Equity Group. Today, I'm excited. We've got Arn Cenedella on the show. So Arn's a real estate broker and investor with over 46 years of experience in the real estate industry. He founded Spark Investment Group in 2020 as he transitioned his single-family rental portfolio into multifamily properties and made the jump. Arn currently manages and operates a multifamily portfolio as a GP, as a general partner, and a sponsor of over 1,000 units with a total value in excess of $130 million. I've got a feeling that some of those numbers may not be, they may be a little dated, so maybe you can key us in. But Arn, excited to have you on the show. Welcome. And I know we're going to provide some value for our listeners, so excited to have you on.
Yeah, Steve, happy to be here. Look forward to having a nice chat with you.
Yeah, no, absolutely. It's an exciting time, I feel like, in the market. The last couple of years have been, everybody's been dealing with kind of higher interest rates, basically the fallout from COVID. And of course, it's jacked up a bunch of our labor and insurance, and we're kind of feeling all that trickle effect. But I feel like there's now we're post-election and we've kind of got maybe a jump start back into the market. People got a little bit newer sentiment, especially as we turn the corner. Like, this will probably be released at the beginning of 2025, but we're recording here at the end of 2024. I don't know. I'm optimistic. I don't know about you, but before we kind of get into Nostradamus and the market predictions, I'd love to get a little bit of your backstory, kind of fill us in for those of our listeners and may not be familiar with you and kind of your backstory. Give us a little bit of your history. How'd you get started in real estate? You've been in the business a long time, so I always enjoy talking to people who've been through different market cycles. But how'd you start off?
Yeah, so there was no grand plan to get into real estate. The typical American kid was told to go to college, study, work hard, do well in school, get a degree, et cetera, et cetera. Ended up getting a master's degree in chemistry, of all things, from the University of Michigan. Never did anything with it. And my father had a residential brokerage business in Menlo Park, California, which is basically Silicon Valley, and had a short call with him. He said, come on out, get your license, and I'll put you to work. And that was March 1978. And I started as a residential broker and investor and did that till about 2014. When Laura and I moved across country for a new adventure to Greenville, South Carolina. And shortly after that, I kind of transitioned into multifamily real estate from a long career investing in single family.
Well, that's a huge jump. You went all the way across the country for one. That's completely different pace of life, I would imagine. I've been to the Bay Area. I've definitely been to the East Coast as well. And it's a beautiful part of the country, no doubt, but very, very different lifestyle. It must have been quite a transition for you guys.
Yeah, we were ready. Laura had a big Silicon Valley career working for Intel, Visa, and Intuit. I did real estate all that time. And yeah, we were just ready for something different. So we're up here in the foothills of the Blue Ridge Mountains, which is kind of beautiful country, a lot of outdoor activity, lakes, things like that. And downtown Greenville is really a fabulous, fun place. So for us, it's perfect. Everybody's got to find their own Zihuatanejo, if you know the movie Shawshank Redemption and kind of what that all means. So we're happy here. We're glad we made the move. San Francisco Bay Area is a great place. But as you note, it's 100 miles an hour, 24/7. It's very expensive. And we had done that for most of our lives and was just ready for something different.
No, totally get it. Totally get it. I mean, again, just the pace of life. I mean, it's a huge, huge change, I think, for most people, if they were to experience it. If you guys have not been to the part of the country that Arn's in, I would highly suggest going. I was actually just in the Smokies, so not too far away from where Arn's at now. It's a beautiful part of the country, but it's just green, it's nature. There's tons of stuff to do. You kind of get that quaint, or a lot of these different towns in some of those surrounding areas. And if you want to get the bigger stuff, you can as well. It's not the big city, but so if you're not used to that, it's a real refreshing change of pace. And it's such a beautiful part of the country. So yeah, kudos to you for making the jump. Now, just to kind of go back a little bit, that's awesome that Dad, was also into real estate. Now, you mentioned that I know you got in on the brokerage side. So on the sales side and whatnot. But was he an investor as well? Now, obviously you were investing. So how did you guys kind of get exposure to investing?
Yeah, so that's a great question because over my career, I found that many residential brokers aren't really investors. And that always kind of baffled me because as an investor, knowing the market is your competitive advantage. And so if you're a residential broker and you want to build a single family portfolio, it seems to go hand in hand. My father was a very good broker, but he was even a better investor. And early on in my career, he kind of sat me down and he said, "Hey, Arn, the brokerage is a business. The brokerage business is a great way to create income. And especially in the San Francisco Bay Area, I saw prices go from a couple 100,000 to a couple million for every house." But he said to create financial freedom, security, wealth, you need to take the income from the brokerage and invest it in real estate. It's the act of investing that creates that freedom and really significantly grows that wealth. And so he was a single family investor, and back in the late 80s, late 70s, early 80s, you could actually buy houses in the Bay Area that made sense as rental. Not sure that's true today, but I got in there early enough. So I kind of followed in his footsteps. And then in 2000, prices had gone up significantly in Silicon Valley and San Francisco. I had the good fortune to start investing in Austin, Texas. And of course, I think most of your listeners understand what's happened to Austin and Texas in general over the last 20 years. So did well with the single family investing and basically learned from my father, and every year or so would try to buy a house. At one point, maybe I was up to about 30 properties. And one of the differences, I was in real estate, I was out and about, I was showing property, I was meeting contractor out and about. A little easier to manage 30 properties when you're mobile and out and about, as opposed to having a W-2 job where you got 4 meetings that day and you got to be in the office. You just can't be running around. So, but even with that, managing 30 different little income units is a chore. And I was able to manage it. But since I moved to multifamily, I actually enjoy having 30 little rental units all in one place. You can have partners, you have professional property management, it makes it better. But single family got my start, and it's a great way to build wealth. It's tried and true, but I think I found a better way over the last 4 or 5 years by moving into multifamily.
Yeah, no, 100%. And we can even dive in a little bit here just for a quick second, because I've run into the same thing. I've worked as a retail agent on the residential side. I started off wholesaling residential property, but you're 100% correct. I've worked with tons of agents hundreds of agents over the years, and you're exactly right. You have a competitive advantage, because that's one of the things that you have to identify going into an investment, especially if it's active income. It's, hey, what's my unfair advantage, right? What can I take advantage of? What can I bring to the table in this particular investing, in this form of investing? And you're 100% right. Like I've met so few agents that actually invest in themselves. It's like you guys spend day to day, you're every day working with sellers and buyers in the market, handling the transactions. You can know it in and out, but they don't invest. Like the vast majority just don't invest, and it doesn't make any sense.
They're watching their clients make a lot of money buying and selling real estate, and it's like, why not get in it and get a piece of that action? That's exactly right.
Yeah, no, 100%. And then now I'm curious too. So you started buying in Texas, you started path of progress type of investing. Kind of what gave you the comfort level, let's say, to start investing outside of your own market? Now in your market, you got unfair advantage. You started investing out of state. That's a big jump for a lot of people. That's thousands of miles away. There's got to be a comfort zone that you're stepping outside of at that area, at that point. What gave you the confidence to do that?
Yeah, that's a great question. So with Austin, Texas, there's a tech industry there. So coming from Silicon Valley, I understood what tech was doing and the impact it had on the San Francisco Peninsula. So you had tech, you have the state government, you have the state university. And in looking at real estate over a long period of time, state government, state university, very stable sources of employment and therefore income. And then you add the third leg of the stool, the tech. So I kind of knew it was going to be a dynamic market. It was starting to move in that direction. And so I made some contacts with some local brokers. They ended up turning me on to some property managers. And knock on wood, the people I worked with were professional and did a great job for me. Understanding occasionally when you go to a new market, there's going to be a little bit of trial and error as you find your key players. And that's just to be expected. And you go into a market, you do one or two deals, you start to build the team, you make adjustments if need be, you get the team working better, you start buying more, and you build up that team as it goes. So it's a process, and I did it over a period of 3-4 years. So I got more comfortable as the thing went on. But primarily, I was really sold on the Austin area. Prices relative to the Bay Area seemed like a great deal. And so I was comfortable making the move. And I knew Texas was really a place that was going to grow. And of course, now 25 years later, the initial thought process has been proven to be correct. I may have been more lucky than good. I don't know, but I ended up picking a good place. So I was happy I did. But I think for all your listeners, we often talk about having a diversified economy, right? That you want to invest in areas that have 3 or 4 major employment segments, 3 or 4 major industries, so that you're not just totally reliant on one industry. So find markets with multiple industries, multiple economic sectors, because while one may be down a little, the other 2 or 3 will be up. And so I think that's a safe way to look for markets, diverse economic, diverse employment, et cetera.
Oh yeah, 100%. Yeah. I mean, this is exactly one of the things that we've learned over the years. The last thing you want to have happen is, hey, you've got one major manufacturing plant in town and they're the biggest show in town. Like they are what drives, and this happens in smaller markets too. I get that some of these places may be, oh, okay, hey, that looks great. It's affordable, especially if you're coming out of a high cost of living environment. You were in the Bay Area, and of course, like we are here in Honolulu. It's like, oh, these little Midwest markets, of course, they look great. Like I can buy a house for 50 grand, like what? Or 100 grand or whatever. It's like, yeah, it sounds appealing, but take a look at all of the market fundamentals. Who are the sources of employment there? And you called it too. Government spending, that's always a huge one. Military bases, one we looked at for a long time. That's also still a great sort. Again, that's also government. Tech sector. So you want a diverse job base, because again, at the end of the day, especially if you're operating hundreds of units, let's say in that given market, hey, we want to make sure that they have stable employment. If they're all dependent on tourism and COVID happens or some other black swan event, guess what? All of that goes away. We saw that firsthand here in Hawaii. You know what? When COVID hit, guess what? If people can't go out and they can't travel, what happens to all of the restaurants and the hotels and everything else? And so, no, I'm glad that you talked about having that diverse portfolio. I'll talk about it here with local investors. I want diversity amongst it doesn't just mean people are familiar with it, stocks and bonds and kind of equities market and all that kind of stuff. I like geographic diversity because, you know what, to all the points you just made mention. And again, that's especially prudent for local investors here in Hawaii because that's so fresh from Hawaii, and you would have seen it too. I feel like even some of the last couple of years, that's hit the Bay Area a little bit as well. Yeah. Well, smart moves for sure. Going to Austin. I'm originally from San Antonio, so I've definitely seen the growth firsthand. Every time I go back to visit anywhere in that area, we've got business and property in Texas. It has exploded.
Yeah, and here's another little tip. When I started investing in Austin, for people who don't know, Austin's about 45, 50 miles from San Antonio, connected by I-35, runs north-south. When I started investing in Austin, if you drove from Austin to San Antonio, it was basically farm country. And now it's wall to wall people. So that's the other thing. When you're looking for places to invest, look for places on major interstates. Like, for example, Greenville, South Carolina is 90 miles from Charlotte, 120 miles from Atlanta, right on I-85. And I can tell you in 20 years from Charlotte to Atlanta, it's going to be wall-to-wall people. It's not that way now, but look for those interstate corridors as good places to invest is another little thing that I would look for that's very important. And I think particularly with our attempt to bring back manufacturing to the United States, as we see was needed for COVID, national security, et cetera, I think those logistical and transportation centers are going to be even more important because we're going to have more ground freight. So as an investor, you try to kind of want to anticipate what you think's coming down the road. And I think we can see we are bringing manufacturing back, which will create greater demand for logistics and transportation. So when you're looking for a market to buy in, try to think about ones that are on those transportation corridors.
Yep. No, 100%. And, I'm not a political person. I'm sure a lot of our listeners are not as well, but the last handful of years now, it's been kind of unavoidable. It is prudent for you as an investor, though, to think about this kind of stuff, to see what's going on in the larger picture. Like, what does the macro picture look like? Because if you're investing for the long term, you want to factor that into your investing strategy. You don't want to buy in a market where the sector is dying out because of shifts in, like you just said, like manufacturing. If that's going away, okay, then hey, don't buy there, because yes, your tenant base is not going to have jobs in order to fill your units. Or the flip side of that, just as Arn was mentioning, if that is coming back, if that is being onshored, hey, okay, where's that going to happen, right? And again, we're not talking next year. This stuff takes years to develop. But you want to be in those paths of progress because, again, Arn, I'm sure you can attest to this too, and you may have mentioned, like, sometimes the market can save your butt. We want to do as well as we can to analyze deals and to underwrite as smart as possible, but sometimes you need a little help from, sometimes having that little boost, having some wins behind you can really help you out.
Yeah, and so we all, I think most of us understand Murphy's Law, that something's going to happen that's not ideal. But what I would say is, and we talked a little bit about it before the show, that a lot of the activity you're doing now is assuming fixed rate debt. So I would say with real estate, long-term fixed rate debt is one of the keys to the kingdom. Because I think historically, and we can get into this a little bit, there are market cycles, and I've been through 4 or 5 of them. And typically what I've seen is you have 5, 6, 7 years of boom, maybe a year or 2 of retraction, correction, then maybe a year or 2 of flat. And that's just basically setting the floor for the next run up. So one can get lucky with the timing, but I would say that's difficult to do. But if you get long-term fixed rate debt and the property cash flows, you can ride out some momentary turbulence, knowing when you come out the other end, you're going to win, because historically the price of real estate, price of housing goes up. I don't really see how the cost of housing is going to go down. So if you go into it right, take a long-term perspective, you can ride out the inevitable rainy days, is the way I talk about it. And with multifamily, we basically had a phenomenal run up from 2012 to 2022. And logically and naturally, there had to be a cooling off. There had to be a correction. And that's occurred. Commercial values maybe have dropped 10, 15, 20%, depending on the deal. But I actually think we're through the worst of it. I think we're now in a period of stabilization. It looks like rates are going to start to come down. albeit maybe not as quickly as Steve and I would like or any investor would like, but I think the trend is down. And so I'm optimistic that maybe we have another 6 to 12 months of relative flat, but then I think we're going to start seeing increasing values. And the other thing I've learned over all these years is once the market turns, it turns very quickly. So for me, I'd rather be 6 months early to the party than 6 months late. So I'm a buyer now. I'm a buyer even knowing they may not go up in value for another 6 to 12 months, but long term, I'm very optimistic that they will go up in value. So if I can find a good property now that makes sense financially, I'm a buyer because I'm looking long term. So I think we're just out of this period of stabilization, ready to go up in the next year or so. That's my crystal ball, Steve.
100%. Yeah. And actually, I think that's a great question. Well, for one, it reminds me of the saying. It was like, stay alive until 25. And then that's the thing. It's like, you have to have income enough. You have to have reserves enough, stability enough to be able to weather the storms. Multifamily absolutely does that for you. If you buy it right, you manage it, and you're not dealing with a bunch of craziness, then it's going to do that for you. So that's having that stability.
And I liked your reminder of ample reserves. It's the rainy day fund. So on all our deals, we have a significant sum of cash just sitting there. They're in money market accounts. They're making our investors 4.5%, 4.75%. So we've got that money there. If there are any unforeseen problems or slight downturns, having that capital available, because in my experience, the only way people really get hurt in real estate is they over leverage the property. And oftentimes with floating rate debt, adjustable rate mortgages, same deal. So ample cash reserves, fixed rate debt, don't over leverage the property and you're going to be okay. The people who get in trouble don't have the reserves to ride through the rough time. And then maybe they're forced to sell in a down market. Absent being forced to sell in a down market, it's going to be a positive outcome by investing.
Yeah. Yeah. And this comes back to kind of what you've mentioned it a few times already. I think having a proper, like, what's your time horizon, like having the right approach in terms of, okay, this is not a get rich quick kind of deal. This is a long-term strategy. And if your time horizon matches, let's say your investing strategy, which it should, then you'll be fine. Right. They've printed so much money the last handful of years. Any hard assets, that's your life raft. So as long as you aren't too aggressive, over leverage, and you'll win.
Yeah, and if so, I would say what happened in response to COVID, printing of money, historically low rates, created a very strange market where people were actually able to flip apartment buildings. Newsflash, that's not a normal market. I would also say for people to think about the really wealthy individuals in America, most of them are long-term buy and hold investors in real estate. So I know 5 years or 7 years sounds like a long time, but the truth is we're so busy, that time just flies. And so flipping apartment buildings is not a normal thing. More buy, operate them, improve them, increase the value, make a good long-term investment.
Yeah, correct. And honestly, it's very similar to, let's say, flipping a house. It's still active income. It's no different than, let's say, active residential sales. So for those of our agents, it's like, well, it's all active income. You still need something passive. You still need something longer term that is, hey, I want to be hands off. I don't want to have to deal with this thing every single day. Just like you have your business to do that. You have your agent business or your flipping business or whatever. That's great. Like, do that. Like, that's no different than somebody else who's a lawyer or a doctor or whatever. Like, that's your active income. That's great. That's awesome. Continue to earn that. But then that's the beauty of real estate, is that you can go take that and park that into passive positions. Let's say into an asset that's going to grow slowly over time. We don't need the hyper volatility. I was listening to an interview recently, and they were pitting let's say Bitcoin and real estate. And it's like, gosh, they're totally different things. It's like, I can believe in both, and it's not an either or. But also one is a long-term kind of proven path to wealth building. The other one is much more speculative. And it's like, if you want to play there, awesome, do that. But I don't necessarily see them at odds with each other, but they're totally different strategies.
Yeah, maybe 1 to 2% of your net worth in Bitcoin and maybe 30% of your net worth in real estate. The way I kind of look at it about investing is that capital you have invested, those dollars get up and go to work for you every day. They put on their suit, their tool belt, whatever vision, but they're working for you, those dollars invested 24/7. And I think Warren Buffett once said, if you don't figure out how to make money while you're sleeping, you're always going to be working. So I think, like, coming from Silicon Valley, big incomes, demanding jobs, people have a lot of money in stock. And I would just talk to them about some diversification into real estate to kind of create that more passive income that then can lead to people being work optional or not having to work as hard. And it gives them some more choices and freedom. And that's what real estate can do for you.
Yeah, no, I absolutely agree with that. And that makes me think, and I'm sure that's where you're drawing it from, The Richest Man in Babylon. If you haven't read that, it's a super quick, easy read or listen if you're an Audible fan or whatever. Excellent book in order to
I've
get
read
that
it.
concept. Yep. Yeah. And that's a lot of times that's what I'll talk to do a ton of networking here, and I have done so over the course of many years. And that's kind of one of those strategies. It's one of those concepts that people, I feel like, need to get a grasp on. It's like, hey, look, if I work for $1, I want to work for it one time, and then it needs to go to work for me. And so then you need to find vehicles as a prudent investor. You need to find vehicles and strategies in order to make that happen. Because just to your point you just made, it's like, if you've got to get up and work every day, guess what? It's going to get old, and it gets more difficult to do the older we get. So
yeah, and I'm at a place in my life that I'm financially set, I'm financially free, but I love doing the real estate, so I keep doing it. But it's different when you do something because you want to versus doing something because you have to. And there's a freedom in that, and there's kind of a joy in it where if it kind of feeds your soul and you enjoy it, you're in a position to be able to do it. So I think the other thing, of course, is people are living longer. So the old model of work until 60, quitting and doing nothing and hope your savings last doesn't really work. It's more, we're now going to have 20, 30 years in retirement. And so you need to keep producing income to maintain your lifestyle. And like, some people may believe that your cost of living goes down significantly upon retirement. In truth is, your cost of living stays about the same to maintain your lifestyle. So you really do need to continue to produce relatively the same amount of income in retirement as you did during your working career.
Yeah, 100%. And then also too, if you have more time, okay, great. What do you want to spend your time doing? Like, it's the most precious asset that we have available to us. And the last thing you want to do is, well, I did this for the last however many years, I hated it, and you're not going to continue to do that. You want something, like you said, that brings life to you, that gives you joy, what good is having the money if you were stressed out all the time in your career, and now you're stressed out in retirement, and well, what's the point?
Yeah,
So,
there's got to be more to it. Yeah.
Yeah. No, 100%. Well, Arn, this is a point of our show where we kind of transition into what we call our fire round, just a little brief Q&A, a little bit more rapid fire questions, a little more fun questions. That something you're up for?
Sure.
All right.
I'll do my best.
Well, we mentioned briefly a book here, but for those of our listeners that may not be familiar with The Richest Man in Babylon, awesome, go check it out. But do you have a go-to book that you recommend to people? And it doesn't have to be real estate. It can be business. It can be mindset. It can be whatever.
Yeah. So a mindset book. It's an old book, but I read it years ago. The Power of Now by Eckhart Tolle. And it just talks about, to the degree we can stay in the present, everything's okay. When we start going to the past or worry about the future, that's where problems come in. So if you can just stay in the present, you're going to be happier and life's going to be a little richer. So that's been an important book for me in my personal development.
Yeah, no, that's a great book. It is a great book. I'm looking over on my shelf to see if I still have it sitting up there. But yeah, excellent book recommendation. All right, next question. What would you consider your superpower to be?
So I'd say my superpower is putting teams together and motivating people. Within my 3-man team, I'm kind of the hunter. I'd say I'm kind of the front man. And then I have an operator partner who handles the day-to-day of doing the apartment business, and it is a business. And then my other partner is the spreadsheet whiz, the financial accounting guy. So the ability to recognize talent and put it together and kind of motivate the team is, I think, what I do best.
Yeah, no, 100%. And yeah, I even love the fact that you mentioned that, because I think it's important for people to remember. A lot of times people are used to working so much as an employee, but I feel like that's a significant shift that you can make from an employee to a business owner, is to understand team building. It doesn't all fall on you. In fact, if it's all on you, for one, that's so limiting. Your ceiling for that is always going to be so much lower. You want to have rock star like that, like the spreadsheet guy. I don't know if you're the spreadsheet guy. I'm not the spreadsheet guy on our team.
And a great book for that is Who Not How. So you don't have to learn to do something. Find the person who's the expert at that skill that you need and bring him or her on board.
Yep, absolutely. Excellent book as well. Yep. All right, next question. What's the biggest lesson that you've learned over your career thus far?
The biggest lesson is to not get carried away. Occasionally, we'll all get balled up in the excitement and values are increasing. So to the degree that you can kind of temper that a little bit, I think that's good. The other thing I would say is, if you're an investor, from time to time, you're going to make mistakes. But try to keep the mistakes small, recognize them, cut your losses, and move on. Don't try to save some failed deal. Take the pain, move on to something better. So that's another good lesson.
That is a good one. Yep, that is definitely a good one. All right, last question. What, if you could go back in time, you had a time machine, you can go back in time to go visit your 20-year-old self, what advice would you have for him?
I would say maybe get smarter about financial literacy sooner rather than later. And honestly, for me, it was until I became a father and had responsibilities that I kind of matured and understood. You got to kind of take care of the financial part of your life. When you're single, it's maybe not as critical. So if I could have learned that earlier, I'd even be further ahead. Not that I have any regrets. We do the best we can and it's all good, but get serious about your finances, try to live below your means, and then invest the difference.
Yep, there you go. Well, Arn, it's been awesome having you on the show. If our audience wants to reach out, they want to get to know more about what you guys have going on over at Spark, what's the best way for them to do that?
Yeah, so I'm very active on social media, either Facebook or LinkedIn, either under Arn Cenedella or Spark Investment Group. And the website is investwithspark.com.
Awesome. Well, Arn, it's been a pleasure having you on the show. I really appreciate you coming on and sharing with me and sharing with the audience. I wish you all the best in an exciting and prosperous 2025.
Yes, I'm very optimistic. I think there's going to be a vibe and an energy in 2025. We're going to really start to see some good things to happen. And so I'm optimistic. Thanks, Steve.
Sounds good. I appreciate it, Arn. Have a great one.
Yep. Thank you.
All right. Awesome. Having Arn Cinedella from Spark Investments over on the show. Again, love talking to people who have been through different market cycles, who have lots of experience in life and in business, and specifically for us in real estate. Always want to learn from people who are ahead of us, whether that be life stages, whether that be in career, et cetera. So it gives it a different vantage point to be able to look into situations with confidence. And yeah, it's great. So definitely check him out. If you guys are over in Greenville or in the Carolinas, reach out. Look to be able to connect with Arn. Great guy. Well, guys, that's going to be it for us today. If you guys are interested in investing with us and seeing what we've got going on in the Dallas market, go check us out at tricityequity.com. You can look at our previous deals, anything that we may have on the table. If you want to partner with us, you can definitely go and connect with us here if you want to network locally at Honolulu Multifamily and more. We meet every month. We've got a great group that comes out, wants to talk shop, learn about real estate, share war stories, share successes, share struggles. We need community. And so, especially if you're an investor, it can be a lonely route, and it's fun and exciting to be a partner with people or connected with people who have a little bit of experience in that route as well. And of course, if you guys are finding value in the shows, please make sure you're sharing the episode, that you're hitting the like button, you're hitting the subscribe, that you're sharing the show, sharing the episodes themselves. And we'd love your feedback. What are we doing well? Are you guys enjoying the guests? If we nailed it, awesome, great. And if there's things that we can improve on and ways that we can improve, we want to know that too. So make sure that you're letting us know. But of course, make sure you like and subscribe. All right, guys, that's going to be it for today. Going to sign off. We'll see you on the next episode. Go out and take some action. Aloha.